All right, I see people trickling in here. See some familiar names. Thank you for everyone who is returning. Also see a lot of new names. Thanks for anyone who is joining us for the first time. We appreciate it. Excellent. While people trickle in, I'll handle some householding items. Welcome to today's webinar here at Plan First Wealth. We'll be covering the 7 tax nightmares that cost British expats money in the States. That's right, everyone's favorite topic here. Thank you all again for attending. I'll be your host today. My name is James Boyle. Quick disclaimer before we jump in. Plan First Wealth is a registered investment advisor. The information presented today is for educational purposes only. Plan First Wealth does not provide any tax and or legal advice and strongly recommends that clients seek their own advice in these areas. One more note, at the bottom of your screen, you should see a Q&A button. Please feel free to send us a question anytime during the presentation today. We'll try to get to them as they come up, as they're relevant to the topics, but we also will have a dedicated time at the end of the session to go through any questions we might have missed. So don't be shy, send them in anytime. Excellent. Looks like everyone's in. Without further ado, I'll hand over to my colleague, Richard, who will start with our agenda today.
Thank you, James. So we will quickly tell you who we are and why we think we have the authority to be talking to you about this stuff. I will then explain why financial planning is different for us British expats here in America. We will then get into the main topics, which is 7 tax nightmares that cost British expats money. Many of these will be familiar to those of you who have attended these webinars before. And then finally, I'll spend just 2 quick minutes introducing our expat optimization system, which is how we go about helping expats in America to make the most of their opportunity. And we will have a question and answer session at the end. Although, please do feel free to ask questions. There's a chat feature down there at the bottom of your screen. Ask questions as we go along. We may answer them there and then, or we may get to them at the end. So please feel free to ask away.
Excellent. We are Plan First Wealth. My partner, Richard Taylor here, founder and CEO of the firm. As I mentioned, my name is James Boyle. I am lead financial planner here at PFW. We are both dual qualified, US, UK. You can hear my accent. I am an American, so you have a Brit and a Yank working here to serve British expats in the States. That is our mission statement, right? Helping expats navigate and thrive in their cross-border financial lives. And on that topic, Richard, why is financial planning so different for expats?
Hey, before we even start, we've just got a massive question already. Sorry. Are the strategies compatible with possible return to the UK, particularly with regard to optimization of IHT income exposure? That is a whopper of a starting question, folks. I will come to this at the end. If you wouldn't mind adding, are you a US citizen? Excuse me. Are you a US citizen or not? Because there could be big, or green card. There could be implications on. The answer is different depending on your immigration status. So, off to a flying start there, folks. I'm excited. Okay. Right. Where are we? Right. Financial planning is different for us expats here in America. It's different because I think in the UK, when we're living in the UK, we have one system to get used to, a retirement system, one financial system, one tax system. We have one system to get used to. And most of us barely get to grips with that, right? You move to the US, you have a whole new system to get to grips with. Not only that, though, you also then have the interaction, because you still have stuff in the UK, you have a system to get used to, which is the US stuff interacting with your UK stuff interacting with the US. Only that's governed by a tax treaty. So there's ambiguities and differences in opinion, and just general additional challenges there. And for some of us, arguably, you have a fourth system to get used to, and that could be the state system. Not all states follow federal tax treaties, which is always been crazy to me, but it is the case. So you go from having one system to get used to and wrap your head around to having up to 4, and complicated by the way they interact. So that just on the face of it is way more complicated and makes financial planning different for expats in America. But then there's also the added complication that the US is uniquely challenging in this regard. The US makes life particularly difficult for anyone with non-US assets. So for expats in America like us, it makes life difficult. And for Americans abroad, it doesn't spare its own citizens. Americans abroad, it can also make life extremely difficult. There's all sorts of additional challenges and restrictions and reporting requirements and potential penalties are, for us Brits, astronomical, punitive. Compared to what we're used to, potential penalties from HMRC, they are off the charts. So not only is it way more complex and ambiguous, potential penalties, even for innocent non-compliance, are off the charts. And I think you throw into all this the fact that I think there's an added imperative for expats to make the most opportunity. You've uprooted yourself, probably your family as well. You've moved thousands of miles to an entirely new continent. You're a long way from your family and friends. Most people, in my experience, move here for the opportunity. They got a tap on the shoulder at work, say, "Come try your hand in America," and I think that just adds an added impetus to make the most of this opportunity. Yeah, and a big part of that is avoiding the landmines. You'll hear James and I talk about landmines. These are landmines, tax landmines that can blow up and jeopardize your financial future. So that's why I think it's different, and that's why I think it's more important for expats in America.
Absolutely. I'm going to share this slide briefly. I'll bring this up at the end of today's session. If what we talk about today, if you have questions on it, if it seems relevant to your situation, you'd like to know more, we are offering exploratory Zoom meetings at no cost, no obligation, 30 minutes. This QR code actually brings you directly to our calendar. Or if you're allergic to QR codes, as I know some people are, especially when they pop up on menus in your favorite restaurants, you can email us. Here's my email here, James at planfirstwealth.com. Happy to find a convenient time. We can talk about your situation. And if we think we can help, we'll outline what that looks like. All right. Without further ado, we're going to get into the meat of today's session.
Misreporting UK pensions to the IRS. This is still super common. And it's not just misreporting, and it's not just UK pensions. It might be misreporting, it might be completely non-reporting. In the US, the US requires the reporting of all, not all, there are some thresholds, but they're very low. So I'm just going to say all non-US financial accounts. That's bank accounts, that's investment accounts, that's ISAs, that's UK pensions, even when no tax is due. And it's that part that catches people out. They think, oh, I've not taken any money out. I've not made any money here. I don't owe any tax to anyone. I don't have to report anything. Unfortunately, that's not the case when you're in the US. The US requires us to report all these different accounts, often on multiple forms. So the most common thing we see is people aren't aware of this requirement and simply aren't reporting, or they are reporting some things, let's say bank accounts, but they aren't reporting other things, let's say pensions, because they don't think they need to, or they're misreporting. They're reporting pensions on one form, but not another. They don't realize it's a foreign trust, for example. So there's myriad ways that this can catch people out. And as I mentioned to you before, the penalty, the potential penalties for this can be pretty draconian compared to what we're used to. So what we always say to people is, if this is you, number one, it's extremely common. Number two, you can repair it. There are programs, there are routes into compliance. Don't bury your head in the sand. Don't hope it'll go away. The day of the age of them not finding out has passed. There is, without getting into details, there is a huge amount of information sharing going on between foreign institutions and the US, and with AI, they probably already have this information. They just haven't gotten to it yet. So, if this is you, know it's extremely common, and be proactive about coming into compliance.
Proactive rather than reactive will be the theme of the day. If I could be so bold. If you're familiar with our podcast, you'll hear Richard say that very often. We'll hammer that point again today, because again, your options are much more wide ranging, much more amenable if you jump on this, sort it out, rather than having the IRS come knocking with an audit or something worse. Nightmare number two, being taxed twice or when the treaty is being misunderstood. The treaty, there is a US UK income tax treaty. I'm sure a lot of you on the call today will know that. It is designed to prevent double taxation, doesn't guarantee it. It's an important caveat. And importantly, it only works if applied correctly. There are specific rules and reporting requirements when you are taking a treaty position, when a treaty is being invoked. That's another very common misunderstanding, right? Sometimes we hear the treaty exists, so I'm perfectly protected, right? I don't have to worry about this. Unfortunately, not the case. It does need to be reported correctly. If it's not, and the IRS does come knocking, they essentially treat the return as if the treaty doesn't exist at all. And then onus is on you to have to defend that position, right? And why you felt that it was a defensible stake to claim for your tax return. Very commonly, we see problems arise when a person is using a U.S. account, right? A domestic CPA who just doesn't understand or misunderstands how to apply the income tax treaty. Doesn't mean there's any ill intent, right? They might be a great US CPA. They just don't have the necessary expertise or experience in the cross border space needed to thread these needles. Without the proper planning in place, without the proper advice in place, you might miss foreign tax credits. You might wind up paying double taxation unnecessarily, or in the worst cases, as we're mentioning here, face an HMRC underpayment notice or an IRS notice in the mail, right? Which is always what we want to avoid, certainly for the clients we work with, and really anyone in the audience, avoiding those worst case scenarios. Nightmare number three, Rich.
This is also extremely common. Before I explain why, I'll just explain what it is. Owning PFIC investments. PFIC stands for Passive Foreign Investment Company. Doesn't matter, but you don't need to remember that. Essentially, what it is all non-US collective investments. So this is UK or European or any non-US unit trusts, mutual funds, including those held within ISAs. So this is really common because, in my experience, or certainly with our clients, most of them come here mid-career, mid-30s maybe, get tap on the shoulder, come to America, get intercompany transfer. By the time you're in your mid-30s, you have pension accounts, you have ISA accounts, or if we go back in time, PEP accounts. You maybe have offshore bonds. You might have a GIA account full of unit trusts. And in my experience, when people first move here, they don't know that they're coming forever. They don't know that they're coming for 20 years. They think, oh, I'll go for 2 years and see how it goes. And if you're going for 2 years, or maybe only 2 years, you don't want to give up your ISA. You don't want to sell all your unit trusts. So people keep hold of them, thinking, how bad can it be? And then that's where we see someone 20 years later who's still got an ISA. And the problem here with these PFICs is the US does not just see them as, oh, that's an index tracking ETF. That's fine. They see it as a non-US investment, and they treat it very punitively. The two main issues are, number one, each PFIC requires a specific form to be filed every single year. It's called 8621. It's quite the form. I think it's probably above most people's ability to fill it in themselves, and accountants charge a few hundred dollars each form. So if you have a portfolio of 10 PFICs, and I saw someone on a forum last night talking about they had 14, that's 14 forms each year you have to pay someone to do. But in most cases, people aren't even aware they have to do this because they aren't aware that they're a problem. Therefore, they've got 1, 2, 3, 5, 10, 15 years of non-compliance. They haven't been filling in these forms. Therefore, their entire return is arguably in non-compliance. So that's a problem. The second problem is the US taxes them. It's very, very punitively. So it's not long-term capital gains. It's essentially it's your highest rate of income tax, and interest is added. For each year you've held it, interest can be added. So this is not a problem that just goes away. It gets worse every single year because this interest issue is building. So this is absolute. Oh, and sorry, for ISAs, it's a particularly bitter pill to swallow because people go from thinking, oh, I've got a tax-free ISA to, oh, it's not tax-free. It's actually taxed at 40, 50, 60%, depending on how long you've held it. And I've got 1, 3, 5, 10 years of non-compliance because I haven't been filling in these forms that I meant to be filling in. So it can get really ugly really fast with ISAs. And in an ideal world, we'd meet people before they moved here and get them to make them aware of this and get them to there are different routes you can take to avoid this depending on what your plans are. But failing that, if you're in the US with an ISA or with PFIX, this is something you want to resolve as soon as possible. It only gets worse. And again, this is not something you want to brush under the carpet because of the non-compliance issue. This is something you want to pick a route and come into compliance that way.
It's such a pernicious problem. You mentioned it, but these are not complex investment vehicles, right? This can be as simple as you use the example of an S&P 500 ETF tracker, right? Something that is incredibly vanilla that a lot of people have in an ISO or a GIA account or an investment account come to the US have no idea that they're triggering these rules. It's not fair, right? But it is what it is, and it's an example certainly of how Byzantine and complicated and complex the U.S. tax system is, and why, honestly, we believe you absolutely need that right planning and advice in place. Nightmare number 4: impact of states' differences where the tax treaty doesn't apply. This may come as a surprise to some of you on the call. Honestly, comes as a surprise as an American. So, as I mentioned earlier, there is a US UK income tax treaty between the US federally and the UK. There are a handful of states in the nation that do not recognize the tax treaty, that pretend the treaty does not exist. California, a very quick example, easy. I'm sure we have some California residents on the call. We certainly have some clients there. A big example of a state that does not recognize the treaty and is fairly aggressive in pursuing tax on some of those foreign accounts. Won't spell out all the complications, right? But obviously, it's going to have an impact on how UK pensions are treated and taxed from a state perspective. UK rental income, right? You might have a home in the UK that you're renting out while you're not there. PFIC rules can be extra complicated when it comes to state implications. Not only are you now dealing with, we've talked about the interaction between the US federally and the UK. Now you have 3 layers to that interaction, right? US brackets federally, US brackets state, and the UK. Also impacts planning decisions, right? So when we think about questions about residency, where am I going to live after retirement? Am I willing to relocate? What do the timing of my withdrawals mean, right? When we look at income planning for our clients as they are getting close to retirement, all of this has downstream effects, right? And you need to be sure if you live in one of those states, you're incorporating that into your financial plan. Number 5, real estate.
Triggering capital gains tax on UK property sales. This is less common, although we absolutely have seen this. We're seeing it right now, as I'll tell you about in a second. But this is a particularly unpleasant surprise for people. So when you sell any non-US, but I'm going to focus on UK because again, to my point about people move here mid-career, they often hold on to homes in the UK thinking they might go back. When they come to sell those homes, the US will take into account the currency fluctuations, and that could make a gain. It could create a gain. It could make a gain worse, or it could actually diminish a gain, which would be helpful in the US. So I'll give you a real example here. This happened to a client of mine. They had bought a house. This was years ago, but for £500,000, and they sold this house, this property in the UK, for £500,000, give or take. Essentially, they made no money in the UK. They had no tax to pay in the UK because you still pay tax in the UK, first of all, because it's a UK cited asset. But they had made no gain, so they paid no UK tax. However, when it came time to do their US tax return, the US looked at the exchange rate changes in that time. They looked at the exchange rate when they had bought the property, and they looked at the exchange rate when they sold the property, and there had been, on paper, a gain in dollars, and they taxed them on that gain. That was not a that was the client had not budgeted for that, was not expecting it. And bear in mind, this money was in the UK. They bought it with pounds in the UK, and they sold it with pounds in the UK. They hadn't converted any money. They had made no money, and they ended up paying a US. They had to pay US tax because the currency had moved in that time. We have another example with a client right now where excuse me, I'm recovering from a cold here, but we have a client in the UK. Sorry, we have a client here who has a rental property in the UK with an interest-only mortgage, and they are looking to, well, they've been looking to refinance this interest-only mortgage. And because that constitutes a change of terms, the US is going to look at the exchange rate when they took out the original mortgage and the exchange rate now when they're remortgaging, and there is a gain on paper, and they are going to look to tax it. We've been frantically trying to help this client find a solution, but it doesn't seem that there is one. So this is something just to be really mindful of and aware of. If nothing else, it doesn't catch you unawares.
you hear this phrase phantom income, right? It is a spooky phrase, and it has some severe consequences, right? Because it quite literally means tax on income you might have never received, tax on a gain you never realized, right? In GBP. So something to be aware of, certainly when it comes to considering whether to sell a rental property, and what that looks like from a remortgaging perspective. Nightmare number six, outdated or incorrect estate planning for dual residents. We look at this as kind of two layers, right? There's the very simple, do you have valid legal documents? Do you have those in both jurisdictions, right? If you're in the US, do you have legal documents? Do you have a will? Do you have powers of attorney in the US, or are you relying on one from the UK? And maybe one that's 10, 15, 20 years old. That's a fairly common situation to be in. This is especially important if you have younger children. Second layer, bit deeper, won't surprise anyone based on the conversation we've had so far. UK inheritance tax and US estate tax interact in very complicated ways. Won't go into all the issues here, but some of the top line ones. Most common, we see trust. That's a massive one. They're treated very differently in the US and the UK. They do represent a very significant and potential tax trap, right? Trusts in the US are almost table stakes, right? You sit down with a domestic estate lawyer, they're going to talk to you about three different kind of trusts that might fit your situation. If you don't have the cross-border expertise in place, you are at risk of running afoul of these rules, either in the UK or the US, right? The misalignment of US trust with HMRC or vice versa. Without a cross-border state plan in place, it's either going to fall to you or in some unfortunate cases, your beneficiaries, right? Where they may face double taxation that could have been avoided, delays, legal conflict, the laundry list goes on, right? You want to make sure addressing these things now such that your estate is handled as painlessly as possible and not donating money to HMRC or the IRS where you didn't need to.
I
Really
had
important.
a. This is not exactly the same, James, but I met with a cross-border tax advisor yesterday, um, and we were talking about her firm, and there's the solicitor attorney there who now pretty much exclusively only deals in foreign trust complications. I dived into it a little bit, and it's essentially expats in America who have unwittingly either become a beneficiary or a trustee or a grantor of a foreign trust, and then the US complications that cascade down on them as a result of that. Not exactly the same as what you just said, but very, very similar. Just estate planning. These two countries, they have a lot of the same language, trusts, wills, right? But you've got to be so careful. You really do.
I had a client earlier in the week that we were talking about this case. I don't know if they're on the calls. I won't share too many identifying details here, but essentially same thing, right? That an elderly parent is undergoing estate planning in the UK. That could potentially mean someone in the US, our client, becoming a beneficiary of a UK trust. Are there complications? The answer is yes. What kind of advice do you need? We can point you in the right direction for a
Yeah.
cross-border estate
That's what
lawyer.
spurred this conversation with the tax
Oh,
advisor.
excellent,
But
excellent.
but if, let's say I could get this slightly wrong, but if you set up a trust in the US and you're a trustee and you move to the UK, which is quite common, from a UK's perspective, then not US, that trust then, because it's got a UK trust, UK trustee, could become a UK trust. So then you've got the US who think you've got a US trust, UK who are arguing you've got a UK trust, and very different taxation rules. And then you can get into the realm of double taxation
Yep.
without relief.
And imagine trying to fight that two tax
Yeah.
bureaucracies, and you're
Hmm.
on the back foot. Not good. Um, Excellent. Number seven.
Okay, so we said seven nightmares. It's really six nightmares, and then we wanted to finish on slightly less miserable content. There are also opportunities. We move here, I think, for the opportunity, and landmines abound, really do abound in America, and I think it's imperative that we do all we can to avoid them, or if we've already triggered them, mitigate them. But there are also opportunities to be taken advantage of. One of the most obvious ones that we encounter on a weekly basis is opportunity cost. So, as I mentioned before, a lot of our clients moved here 20 years ago, not knowing they were going to be here for the next 20 years, or indeed forever. And when you do that, they left stuff in tax in the UK, and 20 years later, it's still there. They've done nothing with it in 20 years. The obvious one is UK pensions. They've got several old-fashioned style UK pensions languishing around. They might have ISAs that finally need unwinding. They might have old unit trusts that are a problem, to my point earlier. And these can these can be actual landmines, but also oftentimes there's just simply an opportunity cost. Had the assets been organized and managed better, excuse me, better over the last 20 years, they could have meaningfully more in their accounts. It can make a meaningful difference. So this is just a plea. Don't tell yourself, "Oh, I'll get to this. I'll get to this. I'll get to this." Get to it, and it can make a meaningful difference to the asset's eventual value. And then another one we're doing more and more of right now is Roth planning. So Roths, for those who don't know it, are very much the US like our ISAs. They're not ISAs because they are retirement accounts, but they are ISAs in that you put money in after tax, it grows tax free, you take it out tax free. Wonderful. Right, that's kind of like that's what you want from an account. Also, they are the tax benefit is reciprocated in the UK, making it particularly favourable for those of us who may one day end up back in the UK. So Roth planning, taking advantage of Roths, doing Roth rollovers if you retire earlier, or if there's a gap when you work, maybe if you do return to the UK, Roth planning can be really, really powerful both in the US and the UK. And then finally, something as simple as pension gaps, and by that I mean state pension. We have an opportunity in the US to build US social security, which is often substantial, but also we have most of us have a past entitlement to UK state pension, which we can top up. And most people, slash all people, should top it up. And that those two together can make some very, very meaningful government-backed, inflation-linked, guaranteed income. That can be really helpful in retirement. So there's just lots of little things. Financial planning really is doing lots of little things right. Being aware of the landmines, avoiding the landmines, mitigating the landmines, taking advantage of every little opportunity that comes along every single year, year after year for decades. That can have a massive impact. And on that note, how we I've been doing this for 10 years now, and this is the formula I think is this is what I consider to be the winning formula. So there's three aspects to this: financial, tax, and estate, especially financial and tax. In my strong, strong opinion, the winning formula is having a financial planner, a tax advisor, and when needed, an estate planning attorney who have a relationship, who are in communication about you, who meet to plan for you. Now that might sound really, really basic and obvious. It is almost unheard of. There are lots of people who've got a financial advisor, a tax advisor, and occasionally an estate planning attorney. But in my experience, almost none have it where those three parties, particularly the financial and the tax, have an ongoing, proactive planning relationship about their client. That is how you do this. With the financial, we build financial plans for our clients, map out into the future, answer the question, are we going to be okay? We manage assets, UK and US, and outside the UK and the US as well, in service of securing that financial plan. We implement tax and income plans when clients get to retirement to help them get into and stay in tax compliance and minimize their tax obligations and draw an income that will outlast them so they can live their life without fear of running out of money. And always, always one eye on the opportunities and landmines. And we link up and work directly with tax advisors who can help with the tax compliance, but also tax minimization, paying what's legally obligated and no more every year, ongoing, and then bringing in estate planning professionals, cross-border estate planning professionals if needed, as and when we need them, to make sure that your US and your UK estate is compliant and you're not leaving a mess for your heirs. We can put this in place. We can manage this. So your three parties, but particularly your financial and your tax planners, have a relationship, are proactively meeting about you. We can work with other advisors, but we can also put this together for our clients. Okay.
Excellent. Thank you, Richard. As I mentioned, just bring up the slide again. If you're thinking what's next, if what we talked about sounds relevant, we are offering the free exploratory Zoom meetings here. That QR code, if you pull out your phone and use a camera, will link directly to our calendar, or you can email me, James at planfirstwealth.com. Talk a little bit more about our website and our content in a minute here. If you haven't had a poke around planfirstwealth.com, you will see a ton of free content we put out weekly. A podcast we call Expat Wealth, blogs, articles on all these topics and more. Certainly, we want to get this information out there to the audience that needs it, which I'm sure will apply to just about everyone on the call today. Excellent. We have had a number of really good questions coming in. Appreciate that. So we're going to go to the Q&A section here. If you have a question, you haven't sent it in, go ahead and do it. Bottom of your screen, you'll see that Q&A button. Go ahead and send in all those burning questions. Let me come out of the screen share here.
Can people see questions, James?
When we go to answer them, they'll see them.
Okay. So let's answer this for the one that came in first.
Okay.
Are the strategies compatible with a possible return to the UK, particularly with regard to optimization of IHT income exposure? And this person is US and Irish. Yes, I actually think this is one of the best opportunities for planning, for proactive planning. You're moving, I don't know what state you're in, but you're moving from likely a lower tax environment to a higher tax environment. So there's absolutely arbitrage that can be done there, but also significantly, the UK I don't think it's come in yet. I think it comes in from next year, from April 2027. The UK has just recently overhauled its inheritance tax or domicile system. Basically, something that's been in place for 250 years has just been overhauled. And the long and short of it is, as things stand, assuming you've been out of the UK for 10 years, you may have a window. It's called the FIG, I think. I can't remember what the acronym stands for, but it's a 4-year window when you return where you will not be considered UK domiciled. And that window might give you a tremendous opportunity to do things like Roth conversions. We used to advise, depending on the state our clients were in, we used to strongly urge clients to do Roth conversions before they left the US. Now, with this new regime in the UK, there might be a window for doing it when you're in that 4-year window. But either way, and that could be a powerful piece of planning. And then, there will be, once you go back to the UK, assuming you become a domicile, then you fall into the UK inheritance tax net. What it was said when I was in the UK, inheritance tax is a voluntary tax. In other words, there was so much planning that you could do to avoid inheritance tax that if someone didn't undertake it, they were essentially volunteering to pay it. I don't know how true that is if you go back as a US citizen, because a lot of the tools that will be available to you in the UK to mitigate inheritance tax will be an abysmal idea for you as a US citizen. So I don't know what the answer to that is, but I would urge you to work with a good cross-border tax advisor, with someone like us, but certainly a tax advisor. There is going to be, I believe you will have some great options. I think this is one of the best. When someone is going back, particularly under this new UK regime, I think this is one of the best opportunities for tax planning to take advantage of it, to arbitrage between the US and the UK different systems.
I think it's foreign income and gains. Just wanted to throw that out there
Mm.
in case anyone
Much,
wants
you
to.
know, much more than coming here. When you're coming here, really what we're doing is you're avoiding landmines, because people just move here with all these landmines. It creates a problem. So when you move here, I don't think there's a great deal of tax arbitrage that you can do. But there's a lot you can do to avoid future problems. But I think moving from the US to the UK, I think there's a lot you can do.
Absolutely. Want to go down the line here, Rich?
George, just yeah, let's take them one by one.
So the question came in. I'm one of those that didn't know I had to report my as yet uncollected UK pension. How do I go about repairing that?
You want to answer this one?
Sure. Yeah. I mean, step one is working with a qualified cross-border US UK tax advisor. We have a list of tax advisors we work with through our clients. You absolutely want to be proactive on that. Very likely there will be a path forward. There's something called streamlined that is designed to help people in that exact situation. Essentially, you're kind of going to the IRS, hands up, saying, "Hey, I didn't realize this was a requirement." I go in and amend the returns and file this reporting that can help cap penalties, mitigate the potential fines that and get you into compliance. It's something that certainly heading into retirement, in our view, you do not want that hanging over you, right? If you are
No.
planning on a retirement plan, an investment plan, an income plan, and a tax plan that you think doesn't have this, swinging sort of scythe, not to be, but you want to make sure you have that buttoned up prior to retiring or as quickly as possible um, to ensure you're in compliance.
I'll just add something to this because this person's also asked a follow on, which is what about UK state pension? So your in your original question, you didn't specify whether you have undisclosed um, final salary pensions, defined benefit pensions, or if you have like a pot of money, like a Scottish Widows or an Aviva or a Standard Life. We call it a defined contribution pension, but like an actual pot of money. The pot of money definitely needs to be declared, and if you've not been declaring it, then that's something to be sorted out. The UK state pension, that's not a pot of money. That's an entitlement to a future income stream. The moment you start receiving that income stream, you have to declare it. But until then, you don't. And this you want this confirmed with the tax advisor, but a lot of tax advisors, in my experience, take the same approach with a final salary pension. You don't own that asset. You're entitled to a future income stream, but there's no asset that you own. Therefore, there's no asset to report. So if that's the case, then you might be okay. I'll just give you the benefit of our experience as well. So I mentioned missed assets that haven't been reported. I mentioned PFIX and I mentioned capital gains on property transfers. We've seen all three of these have come up. Some of them very regularly in our practice. Here's what I've seen. The US does levy penalties. There's plenty of court cases out there that can prove this. They levy the penalties. What I have found, though, in having done this for 10 years and having worked with many, many clients who have fallen into this trap, myself included when I first got here, is when someone has taken proactive steps to come into compliance and followed one of these procedures that James is mentioning, they haven't been levied with the penalties. And I think that may one day change, but I think that's a testament to the power of proactively saying, "Sorry, Gov, it was a mistake. Didn't mean to do it. Here's everything." So that I think people should take comfort from that. PFIX, unfortunately, there's no getting away with it. If you own PFIX, they're taxable. They're punitively taxed. There's no out there, unfortunately.
Speaking of PFIX, we got a question here. Are shares quoted on stock exchanges considered to be PFIX? Sounds like, Paul, you're referring to individual securities, a share of Apple or a share of Microsoft. Those are not PFIX. But keep in mind that things like ETFs, collective investments, are listed on exchanges. So I just want to, make sure that's clear. If it's an individual company security, not a PFIC. If it's any kind of collective investment, OICs, mutual funds, ETFs, very likely to be a PFIC.
Individual shares are fine.
Yeah.
Is it passive foreign investment companies? It's collective investments. It's not. I could get into technical details, but individual shares are fine. Unless,
Couple
sorry, I should mention there is one, and this is a real life example here. I recently met with someone who was, before they left, had been made aware of the PFIC rules and therefore bought an investment trust. An investment trust is a listed company. It's an individual equity, but rather than it being like a trading company, like a BP or a Shell or whatever, it's actually just an investment company. So within that, there's an investment manager, and they're buying and selling individual shares. I believe that whilst that is a listed individual equity, a listed individual share, that I believe is still a PFIC. So that person hadn't solved that problem. They'd actually just they'd gone from one PFIC to another.
I do have the list here. I had a feeling we were going to get this question, so I pulled this list. These questions are asking what states do not follow the treaty. You want me to run
Before
through this
James
list?
reads it,
Okay.
before James reads it, well, there is a list here, but also bear in mind they it's not uniform. It's
Yeah.
not the all these states do one thing and these 6 or 7 states do something else. It's these all these states follow the treaty, but these 6 or 7 states arguably don't, but in different areas.
Yeah. Yeah. And if we can pontificate, that usually means then the downstream effects are different, right? And planning needs to
Yes.
be different.
Yeah.
California is going to treat things much differently than, I don't know, Maryland or New Jersey or Alabama. They're
Yeah.
all going to have different approaches to the impacts that this has. Massachusetts is not one, Ed, so that's good news. I'll just run down the list. It's Alabama, Arkansas, California, Connecticut, Hawaii, Maryland, Mississippi, New Jersey, Pennsylvania. New Jersey and Pennsylvania, where I was born and where I am now. So if anyone's
Let's
listening
go
and you
where I
fall
am.
under those handful of
Mm.
states, it's worth looking and exploring what the implications might be.
California is the most difficult one,
Yeah,
obviously.
yeah,
Always. I
yeah,
love California, but
yeah.
they don't make it easy.
An interesting
Go on.
question. Given all
Give
the
a
landmines, of which there are many, as we covered, should we give up our U.S. dual citizenship, liquidate all our U.S. assets, and return to the U.K.?
maybe not a bad idea, but if you're a US citizen, you've got to worry about the exit tax regime. It's too much for us to get into here, but if you have a net worth of more than $2 million, worldwide assets, and this includes non-UK, non-US pensions. If you have more than a net worth of more than $2 million on your worldwide assets, or if you paid more than a certain amount of income tax, but that tends not to catch people, it's a $2 million net worth. Or if you cannot certify that you are in full tax compliance for the last 5 years, that's the trap. By the way, it doesn't sound like much, but that's the trap. You are going to be what's called a covered expatriate when if you were to give up your US citizenship, and you would then be subject to the exit tax. The exit tax is a whole thing, but essentially they pretend that you liquidate everything you own the day before you left. So every property was sold. It's not, but every property was sold. Every retirement account was distributed. Every investment was sold, and they give you a tax bill for that on the way out. Bear in mind, you haven't actually sold anything. So if you move to the UK and then you sold your properties, then you sold your investments, then you took me out your pensions, the UK would look to tax you again, and I believe there'll be no taxation relief here because it's a phantom tax. It's not you've not actually sold it. So I think this question might have been a bit facetious, which I totally understand. I think about this a lot, but because in the face of it, it would be much easier. But giving up your US citizenship is not like giving up your is not like giving up any other citizenship, as far as I'm aware. So, and then also if you have US citizen children, any amount of money that you give them is subject to a transfer tax at 40%, any amount, and it's on them to disclose it and pay that to the IRS. So, being a covered expat, which happens when you give up your US citizenship potentially, or for green card holders over a certain amount of time, is a minefield you want to be careful of.
It's not to sound too milk toast here, but it's very manageable, right? We work with people every day, our clients who are going to stay in the U.S. who have these complications, who have non-U.S. accounts, very manageable with the right team in place, right? Obviously, we're biased. We think you're best served working with a cross-border financial planner who understands these things. At the very least, you want to be working with a cross-border tax advisor as well. It's certainly doable. Let's see. This question come in. If you're selling your previous primary residence in the UK, does that change the capital gains that are required to be paid here in the US? For example, we bought a house in 2015, seems like in the UK, lived in it for 8 years, and then rented it out when we moved to Texas.
I actually don't know the answer to this. I feel like I should. Um, First of all, are the US is the US going to look to tax growth before you move to the US? I'm thinking back to my example here. I don't know. I don't know. Is the answer to that? Yeah, I don't know.
My instinct is that you would. I think if you're a U.S. taxpayer, when the capital gain arises, they're going to look at the whole history of it.
What do they do for PFIX?
Yeah. The other question, which it sounds like if I'm kind of reading into this a bit, um, in the U.S. there's an exclusion, right? If you've lived in your primary residence for two of the last five tax years, would that apply to a foreign property? I don't know. I
Well, also, what about if you lived in, what about if you lived, would you get that in the US if, so I've lived in this house for 5 years, right? Let's say I moved somewhere else and then I came to sell this property. Would I get relief for the 5 years I lived in the house or not?
You need to have lived there. This is testing some of my CFP
Uh,
knowledge. Two of the previous five tax years, I
so
believe.
the
So
fact
it
I've
had to be a
gone
recent. Yeah,
just means I don't get any relief for the fact that it used to be my private
right,
residence. Okay.
right. Yeah. Similar, well, similar question or a related question. How does capital gains work on selling UK property? Can you include investment made in the property? Can you use 1031 exchange between US and UK?
So that's a tax advisor question. I don't know the answer. I think I had a client who sold a Mexican villa and parlayed it 1031 into a Boston property. I could be misremembering this because I remember being surprised that you could do that. So I would seek tax advice for that. I think I have an example where that happened, but I could be misremembering it, or I was told, a client told me he was thinking of doing it and he never actually did it. But he definitely did buy a Boston property.
The first part of the property, I would say yes, right? You're looking at the capital gain would be net of
Oh, I missed that part. Yeah,
improvements to the
sorry.
property, right? So that
Yeah,
would lower your
yeah, yeah,
gain and essentially,
yeah.
yeah, you could still do that, Gary, to our understanding.
Sorry, I saw 1031 and got excited.
My 25-year-old daughter is a U.S. resident and citizen, only citizen in the U.S. Sounds like inherited $100,000 being held in the UK until she is 28. What do we need to do?
So there is a requirement, a little known often trips people up this one. When you receive a gift or an inheritance from a foreign person that is over $100,000, it has to be reported to the IRS on Form 3520. Doesn't mean any tax is due. It just means that it needs to be reported to them on Form 3520, and if it doesn't, they are pretty hot on penalties for this one, up to 25%. So you want to, ideally, she's just below $100,000, but that threshold is pretty critical. And if it was last year, 2025, then great, you still have time to submit a 3520 with this year's tax return, which would avoid this problem. So fingers crossed that's it, and you can. This is not an issue for you or for your daughter. Also, bear in mind, even if she's not taken, even if she's inherited it, but it's still in the UK, any income on that, any gains, any growth, that has to be reported in the US and is taxable. But the 3520 issue is the one that trips people up. So look into that.
A couple questions on SIPs here. What about SIPs? Reported on FBAR. Does it qualify as a PFIC?
No, so a SIP is a SIP is a pension vehicle. Usually, again, this is tax advisor territory, but I'll give you my experience having worked with many. SIPs need to be required on FBAR, and usually, because they are considered, this answers the next question as well, because they are considered a foreign trust, a foreign grantor trust. Most tax advisors, in my experience, agree that they need to be reported on Form 3520 and have a Form 3520A submitted for them as well. At the very least, if you don't do that, you should be doing an 8938. But I believe if you do a 3520, it mitigates the need for an 8938. And so they're not a PFIC, they can hold PFICs, but again, tax advisor territory. But in my experience, Tax advisors are okay with SIPs holding PFIX because they look at the SIP and stop there. But there are additional reporting requirements.
Put it a little differently, just in case I'm reading into it a bit, but SIPs, to our understanding, usually we'll see tax advisors treat them as have the protection, the treaty protection that ISAs do not. Right? I don't know if that the PFIC ISA conversation maybe was influencing that question, but SIPs tend to be treated as protected from that. A couple last questions here. Coming up on time. We would like to move to the UK for 10 years ish and keep our 401k going until we are 60 in the US. Do we have to report to the UK?
I don't think so. It's not the same as it is in the US where you have to report your non-US assets. I don't, well, um, if you take advantage of this FIG regime I was talking about earlier, there may be a requirement to report everything. But just standard, I don't believe there is a requirement to report on your non-US assets until you take an income from it, and at which point you absolutely will have to report it in the UK and pay income tax. But you will also probably get tax at source in the US in a 401k.
And if you have, I'm expanding the question here, but if you have non-pension accounts, non-retirement accounts, anything outside of a 401k, maybe you have a regular investment brokerage account, uh, there can be negative treatment of the US investments when you're a UK taxpayer. Something called
Yes.
a
Yeah.
reporting fund. So that's probably worth keeping in mind. If you have anything, if you have investments outside of a 401k, there are strategies that you'd want to look at to make sure that those investments are playing nice with HMRC while you're a UK tax.
Yeah. That's like the flip side to the PFIC
Yep.
regime. It's not as punitive. It's not quite as punitive as the PFIC regime. But if you're going back, we get lots of clients who go back with um, sizable brokerage accounts. You want them to be invested in assets that are US and UK tax compliant and tax efficient.
Yep.
Save yourself a lot of money doing that.
Excellent. One last one here. Ask about reporting. When you are referring to declaring accounts such as pensions, is this the F bar 114A?
Bar is one such form. There are usually others. With pensions, if we're talking like a old style Aviva, Scottish Widow, Standard Life, personal pension, stakeholder pension, workplace pension, then yeah, you likely have F bar and 8938. It's two different systems. F bar goes to the Treasury and it's to do with bank secrecy. 8938 goes to the IRS and it's to do with FATCA, Foreign Account Tax Compliance Act. If you have a SIP, you likely have, again, this is tax advisor stuff, but you likely have F bar and 3520, 3520A.
Just to kind of highlight the point here, we do not recommend filing taxes on your own if you have foreign accounts. We recommend working with a cross-border US UK tax advisor. The complexity here is such that trying to go it on your own, we believe, is going to lead you potentially to missing things, and penalties are harsh.
Crazy.
So we can name forms like F bar 8938, 3520. You do not want to be sifting through these forms and trying to file them yourselves. If I can encourage everyone on the call to take away one thing, send us an email. We're happy to share a list of US UK tax advisors in the States and the UK who handle this.
Um, Live full time in the US. When I start to collect my UK state pension, will I be required to file UK taxes? D, probably not. So, uh, your UK pension, if you've got nothing else, your UK pension will be paid through the PAYE system. Remember that? And you're going to be below the personal exemption in the UK on your state pension. Therefore, they'll probably just pay it out to you gross. And if you've got no other income, you won't need to file a tax return. Even though you're in the personal exemption in the UK, that still needs to be declared in the US. This is actually something that see people getting wrong all the time. They say, "Oh yeah, But the £8,000 that I get from the UK, it's within the personal exemption, therefore I don't have to pay any tax. Well, it's within the personal exemption in the UK, but you still have to declare it on your US tax return and pay US tax on it. So just be careful. Just be careful not to fall into that trap. But I don't think any UK tax return will be required if there's nothing else.
And you might have mentioned this, but the UK state pension is paid gross, no tax withholding at source, which makes things a bit easier too. Um, of a UK pension, previous UK employer pension, no contribution since I moved to the US in 95, just sitting there. It's been growing. It's not large.
Well, so there's actually two answers to this, and we're really getting into the weeds here. So, absent any other information, that probably has to be reported. So if it's more than $10,000, it has to be reported on FBAR. And if it's more than, I think it depends on your filing status, married filing jointly, but broadly, I think it's if your combined non-UK assets are more than 50 or non-US assets are more than 50,000, that should be on 8938 as well. That being said, a huge caveat here. I believe there is an exemption for what's called an employer trust, and that's when the employer contributions were more than the employee contributions. So I am out my depth here. I am not a tax advisor. As you probably gather, James and I have a lot of tax knowledge given what we do, and we try and bring this to bear in helpful ways, bringing these things to life. And this is way above my pay grade. But I do believe there is a distinction when it's an employer scheme and the employer made more of the contributions than the employee. And if that's the case, you may be exempted from some of that reporting. But I would check that out. Don't rely on me pulling things from the back of my grey matter here.
Excellent. We're coming up to the hour here. Again, very sincere thanks for all who have attended. Like I said, we see some familiar names, which we always appreciate those who are engaging with our content, and also a large number of new faces here, which is really appreciated as well. If you haven't checked out the website, planfirstwealth.com, go on there, have a poke around. We have a ton of content completely free available on these very topics. We do a weekly blog. We have specific technical articles on these topics. If you're someone who likes to do some of the research on your own. Importantly, we also have a weekly podcast. It's been going for some time. We were bi-weekly. We're now coming at your inbox every week. It's called Expat Wealth. You can find it on Apple Podcasts, Spotify, anywhere you find podcasts. Go ahead and follow us. Like I said, we bring on tax advisors, estate advisors, other SMEs in this space, this cross-border space. We want the information to get out there to the audience that needs it. So check that out if you haven't already. Richard, anything else you'd like to cover before we head out?
No, no, all
Excellent.
good. Thank you, everyone.
Thank you all for attending. Cheers.
Cheers.